I think we've all heard that expression of people keeping money under their mattress.
Yeah.
Oh, yeah.
And I mean, I think the pandemic showed us that in a digital economy, that's really hard to do. So Craig, why do we have banks?
Banks are financial intermediaries. They play a really critical role in the economy by basically taking the money that, they accept deposits from savers, and then they take the money that they get from the savers, and then they extend it out through credit to individuals that need to borrow or to businesses that are looking to borrow. So banks are the middlemen of our economy, and they basically keep the real economy actually operating.
Well, what do banks offer that carrying cash doesn't?
Well, most essentially, it's that matching function, that it gets people who have excess money that they've saved together with people who want to borrow that money to deploy it for a new business, to buy a home, to pursue their education. It's almost like, online dating, gets people together, or Craigslist or Kijiji gets sellers and buyers together. Banks are a site that matches savers with investors.
But the thing that not irritates, because obviously I have a bank account, but I always feel like there's like a power imbalance when it comes to banks. It always seems as if the banks have an upper hand, but banks wouldn't exist without our money, right? Mm-hmm. But is there that power imbalance? Is that intentional, or is that imagined, or is that depending on if you have lots of money?
Well, there's so many questions in there. I mean, the first thing I would say is just to add to what's been said about the purpose of banks is generally it's a safe place to store your money, and it's also then a place where you can access a loan, but banks can put in all sorts of rules, and you might not have any control over what those rules are. If you're already banking somewhere and you have a loan and then they change the rules, all of a sudden you get stuck with not having access to your money. And then there is a little bit of a power imbalance there, for sure. And then, of course, we have credit unions as well on top of banks, or in addition to banks, that do very, very similar things in a way that pools sort of community.
What's the difference between them?
One's not-for-profit and run by members, and then the other is shareholder-driven.
Shay?
Yeah, I would just add to, or co-sign, a safe place to store your money. Also, too, if you have a savings account, you may earn a little bit of money. It's not the best, but, you're able to earn some money on your money, versus if it was under your mattress, you wouldn't be earning anything. Your money would actually be losing its purchasing power. So, yeah, there's definitely a need for it, but I do think there is a bit of that. There is a power struggle, but also there are a lot of fees that come with it, for example, and
Just to put your money in, you get charged for it.
exactly, and some of us may be familiar with the famous NSF fee, where if you don't have enough money, you get charged.
Non-sufficient
There's
funds.
that-
Is that non-sufficient funds? Yeah.
And there's
I
that
know what
collective of like, well, if I don't have money, like, how are you charging a broke person a fee for not having money? So
And then negative in your account.
Yeah, so I guess that's a downfall. But again, it's like, okay, where else are you going to put it? Well, you can invest it, of course, but outside of that, where would you put it? It's just going to be in your home. More unsafe, not earning anything.
Maybe a sense of security by having it in the bank, or maybe some people think it's safer under their mattress.
It's definitely safer in the bank, particularly given that deposits in Canada are insured up to $100,000. So, when we think about banks, the traditional banking model was you deposit your money into the bank, and the bank will pay you a certain amount of interest, and then it takes the money that you've given it lends it out at a higher rate of interest, and the difference between the two is where the bank makes money. I think one of the challenges when Canadians think about banks, particularly in recent years, is the fact that interest rates dropped to such low levels that in point of fact, you weren't getting much of any interest when you put your money in the bank. So, when you're thinking about, the bank is providing you a service, which is where we get the service fee from, right? Like they're providing you with a service. So So you pay something to the bank for that. That was okay when you were getting a decent amount of interest on the savings that you put in the bank, but when you're not making much in the way of savings, all of a sudden the perception of the bank really fundamentally changes, right? Because it doesn't feel like, hey, I'm making a return on my money, and yeah, I got to pay you something for the service.
But do you
you're
have a
giving me.
choice? I mean, you have your bank in the,
Well,
you have your money in the bank or
it's
not.
hard not. It's hard to live without a bank. And in fact, one of the things we worry about is Canadians that don't have access to banking or are underbanked, because it actually can create enormous problems for them. So for example, if you don't have a bank account, how do you get paid by an employer? Right? So you absolutely need, so it is an essential service that banks provide. It's hard to do it with, it's hard to live without having access to banking, and I think the power partly is the function of the contracts, right? That when you enter into a contract with the bank, right, there's terms associated with what you've agreed to.
But it's like 20,000 pages long when you sign up.
Well, and there's definitely a financial literacy issue here that Canadians don't necessarily know what the banks are obligated to do. There is a recourse if you don't think your bank's been treating you fairly, you can go to the Financial Consumer Agency of Canada and log a complaint.
I didn't know that was a thing.
Banks have ombudsman where you can lodge a complaint with the bank and have an independent assessment. Canadians actually often don't know their rights, and that I think might also contribute to the uneven power sensation that you were referring to.
That's good to know, Craig. Thank you. Kaylie?
Well, I'm thinking about this power imbalance, and that when you're looking at, say, lodging a complaint against this huge conglomerate, and you're yourself with an NSF charge on your account, it doesn't feel like you have any recourse at all. So to know those things, maybe even like when you're opening a bank account or going to a new bank to ask those questions, would probably be something that would increase your power quite dramatically in those situations.
And the power of Canadians in their relationship with banks is probably greater than they realize. If you look at all of the major banks, they are falling over themselves to sign up new Canadians, either before they even get to the country. Many of them have offices in our major sources of immigration to try to get people involved as clients before they arrive here, because they know once you're signed up with a bank, you are very reluctant to change your bank, because there are a lot of administrative costs, there are a lot of hassles involved with that. But if you actually do exercise that change when you see offers from other banks, that actually increases the power of consumers. And similarly, right now, as interest rates have gone up, banks are competing with one another to a greater extent to get deposits in, because those deposits are what they need to finance those loans that they make money on.
Oh, it's nice to be taken out for dinner once in a while.
Well, or get one of those
record it.
iPads that are being given away,
That's
or
right.
$300 for a new
But they only give
account.
it to new customers. I'm like, I've
That's
been with you
right.
for 15 years.
Yeah.
Well, Canadians should, if you have a bad experience at a bank, there's nothing that stops you from taking your money out and going someplace else. And the fact is, when we look at data, it shows that Canadians are enormously reluctant to make that sort of
It's
change.
a lot of work.
It is a lot of work.
It is a lot of work. But if you have a bad experience at a bank and you threaten that you're going to take your money someplace else, you are more likely to get a response. And quite frankly, if you've had a bad experience, change financial institution, right? To your point, you had a bad experience and you basically decided right
Never,
there and
ever,
then
ever.
you were never going to be a customer of that bank
No.
ever again.
No. They even came asking for a mortgage. I was like, no, thank
But
you.
there's a
And
lack
it's
of
not all or
financial
nothing.
confidence.
Yeah.
I mean, you can have business with a couple of financial institutions. You can be
Right.
involved with a credit union that's located in your community and one of the larger financial institutions, and you get different services from them. It's not like you have to give all of your faith to one. The other question that it raises, though, is the level of competition in the banking and financial industry in Canada. We have a very centralized financial services industry compared to the United States, for instance. And one of the big policy questions we debate again and again is whether that should be opened up to more competition at the financial institution level, because with more competition, that would probably shift a little more power to individuals over how their money is treated and what terms they get for depositing it.
Well, since you brought this up and we've talked a little bit about interest, can you help us understand what's the difference between a bank and the central bank? Do you want to take it, Brett?
Sure. The central bank is a public institution. It makes big decisions about the supply of money that's available in the economy at any given time, and it sets interest rates, so the ease or the cost by which people can borrow. And in some countries, not all, it also has a hand in regulating the financial services industry.
We've been hearing a lot of pain around inflation, paying more at the groceries, more for everything, more for gas. And then we heard the central bank come and interest rates went up, so people had more pain that way. What point do policies and politics get involved in the bank? Craig?
The Bank of Canada is, even though it's a public institution, it has a very high degree of independence, and that is deliberate, because quite frankly, you don't want politicians deciding interest rates, because they would use it for short-term gains politically, which is why there's a board of directors of the Bank of Canada. They choose the governor and the senior deputy governor of the Bank of Canada, so they pick the two most important positions. Now, cabinet in Canada, so the government, the current government's cabinet has to ratify the person that has been chosen by the board of directors.
You mean vet?
They have to basically say, yes, that person is acceptable to us.
Okay.
But the important thing is that the board of directors of the central bank are the one that basically say, here's the person we're putting forward. Right? This is the person we think is qualified to do the job, and we think this is the person you should agree should be the next governor of the Bank of Canada. Right? And then that person has a term of 7 years, and it's chosen 7 years so that it's long enough to it's long enough that you're not going to have constant changes in the conduct of policy. It emphasizes the fact that the goal of the Bank of Canada is to preserve the purchasing power of money, and the way they do that is by striving to keep inflation low and stable. And I know that sounds ironic in the current environment. But if you actually look at, since the Bank of Canada started targeting inflation in 1991 and started aiming for the 2% target in 1995, the average rate of inflation in Canada has been 1.95%, up until the pandemic, up until the recent inflation shock. So they've been enormously successful. Unfortunately, the pandemic basically broke a bunch of rules in terms of central banks globally, governments globally, and the policy response and the breakdown of the supply chains led to an inflation shock that we're now struggling with. So the Bank of Canada, I know that Canadians don't like interest rates going up, and this can create a lot of strain on Canadians. But in the long term, what you really should take away from the current experience is how bad inflation actually is for consumers. And we desperately need to get inflation back down to something that's low and stable again.
Kaylie?
Oh, I'm so glad.
Yeah.
There's so many thoughts that I have running through my head at this. And okay, so the first thing to add is that the Bank of Canada also has a mandate that's set by the federal government. At one time, it was strictly about the rate of inflation targeted between 1% and 3%. And then I can't remember if it was 2020 or 2021, there was an addition made that the Bank of Canada is also supposed to focus on full employment. So keeping inflation low as well as keeping Canadians employed. So now we're in this moment where we have seen high inflation coming down, but essentially the Bank of Canada is trying to slow economic growth. They increase interest rates, increase the cost of borrowing so that businesses aren't investing, and that means that the economy isn't creating as many jobs. Potentially means that wages aren't going up or keeping up with inflation, and potentially means that people might lose work if this bout of interest rate increases ends up creating a recession. And all of a sudden, what we've done is take the pain of increasing prices and put it on a few people who get put out of work.
Help us understand
Why
is that? Because it feels as if it's counterintuitive. I don't know. If people are struggling, then they're going to struggle more, and that's going to help the economy. How?
Exactly. That is a very good question, and it's something that we at Unifor have been talking about a lot. It's kind of what's the word I'm looking for? Like, what a conundrum, or like screwing with your mind when, okay, people are struggling, they can't afford things, so we're gonna, create fewer jobs and lower wages or decrease purchasing power of wages in an attempt to keep inflation down so that then people aren't struggling so much. But at the same time, we're not keeping up to what's been extended or what's happened. It's a very, very confusing situation. What we would have looked for is for the government to also step in. So very important for the Bank of Canada to be an independent body, absolutely. There are also many things that the government of Canada could have been doing in order to keep inflation low. I mean, you could think of things like price controls, or dealing with profiteering as well. We've seen profits rise rapidly, take a much larger share of the economy than was the case before the pandemic. But workers and wages are the only kind of target of the interest rate increases, and no one's talking about trying to keep profits low. So we could have seen in the last budget an increase, say, dealing with corporate profiteering, higher corporate profit taxes in order to redistribute that money and potentially stop profiteering in the first place so that so that inflation doesn't keep rising.
I know the government gave I think $500 for food, but I mean.
There was an addition to the GST rebate, which they cast as grocery support, but it's really for almost anything.
Right, that's like a week. Anyway,
No, but on the conundrum that you pointed to, why is a rise in interest rates useful when people are already experiencing problems with costs? And I'd echo Craig's point that inflation ultimately hurts people at the lower end of the income level, where they typically don't have assets that are protected against inflation. They're relying on wages for most of their well-being, and when the cost of goods and services is going up, typically their wages don't go up quite as quickly because they don't get reset every day along with price tags in the store. They get set maybe for a year or 2 or 3 years at a time. But I would say the central bank is never trying to just simply dampen growth for the sake of doing so. It's trying to bring the demand for goods and services and for workers in line with the actual production capacity of the economy. And right now, if you look at, it's not quite a dual mandate. I would say the inflation target still remains the principal mandate of the Bank of Canada, but there was some verbiage added to his mandate saying, and take account of employment too. Employment is at an incredibly strong point right now. We have some of the highest participation rates in labor markets that we've ever had, and some of the lowest unemployment rates we've ever had. So, there isn't an obvious need that we need to try to emphasize that part of the discussion of the mandate. The real problem is inflation still, which is too high and undermining the purchasing power of low-income Canadians.
And when we say, because all of this seems so high level, but all of this stuff is affecting individuals on a daily basis.
It is.
Shay, how do you see it? How do interest rates affect people?
So interest rates affect people. So first, interest rates, you can look at them as a bonus on your money if you're looking at savings and investments, or you can look at interest rates as a fee when it comes to debt. And essentially, interest rates affect the growth of our money, the growth of our debt. And a lot of people actually, I'm on the ground actually talking to individuals who need help with their savings and debt and insurance and investments, and a lot of them actually don't even understand what interest rates are and how they affect their money. So they're putting their money into things that aren't growing, for example, a basic savings account, and then their debt is super high, which we know the interest rates for credit cards average used to be 19%, now it's probably like close to 24%. So your money is growing at 0.01% average, and your debt is growing at 24%. And they don't understand why their savings aren't growing and their debt is. So just understanding what interest rates are, how they affect our money, will help us put our money in different places, but also prioritize debt. Because there's a lot of people who have a lot of debt and it's kind of like, I'll get to it whenever. But if more of your money is going towards debt than savings, this is how we're not really able to afford the things that we need to afford.
On the flip side too, I think credit cards have probably become like a lifeline
That
for
too.
a lot of people, especially during the initial upheaval of the pandemic. And sometimes I feel like, I remember when I started university, and the first week when you go to university, there's like a row of banks. Here's your credit card, right?
Yeah.
And I didn't know anything about money. I was like, oh, free money. Duh, no.
Literally.
And my credit, I'm going to admit this on television, was ruined over $500.
Yeah.
Because as a student, I didn't have $5. I put myself through university.
Yeah.
So I wanted to just kind of, when we talk about inflation, when we talk about credit cards, when we talk about interest rates, I do think there's a lack of understanding from the public. Because I think also banks are like, okay, put your money in savings. Why not push it to other places so people can make more money, right? Because when you sign up, checking and savings, nothing else is really offered until your money starts to climb a little bit.
Right.
Yeah.
I think it's an overall lack of financial education, because also too, like that situation with people offering you cards and stuff, like some of them actually offer it as a rewards card. So even just not understanding like what a credit card could look like or what it even is, we get, I don't know, bamboozled maybe, and actually think that this is a reward card when it's a credit card. So I think there's a lack of transparency on that end. And then also too, I don't necessarily know if the bank's job is to build investors or to build people who are financially educated. And so
It's a
maybe
business,
that's
in a way.
not why there's education on, okay, you need a checkings account, you need a savings account, but you also want to make sure you're opening up a TFSA, and this is how you actually use it. Tax-free savings account, we know we get taxed on almost everything. How do we reduce our taxes so that our money can grow more? There's a lack of education there as well. So I just think a lot of it comes down to the lack of education, right? And also going back to like scarcity, these reward cards or credit cards are appealing to a lot of people because it's money. It's extra money that people can use to spend, or money that they didn't have, right? So
They're enticing.
it's enticing, 1000%. But on the flip side too, when you understand the power of leveraging money that you don't have to buy things that are gonna produce cash, that's where leveraging debt in a good way versus just racking up credit card debt is helpful.
We're going
right?
to talk about debt in the next
Yes.
show.
I think a theme that comes up again and again over decades is the lack of investment in financial literacy education. And that's a problem we've talked about since I was a kid in the 70s and early 80s, and that hasn't changed substantially. So one question I think we need to reflect on is, why haven't we moved on that in the education system in a profound way, particularly when financialization of people's lives has gone light years ahead of where it was years ago. So many benefits that government delivers, so many policies that are meant to help low-income people or people to buy a first home or to save for retirement are all delivered through the financial system now rather than direct government payments or programs. And yet we're not providing the concurrent education for people to really understand how to use those tools effectively.
And the older you get, these mistakes can have real significant impact on your life, no?
Absolutely.
Right.
No, financial literacy is really important, and having worked at a bank, I can remember having conversations within the bank about the programs that it was running to promote financial literacy, and in some cases, the individuals I was talking with are saying like, "Here's all the things we're doing," and I'm like, "Yeah, that's marketing. That's marketing. that's actual literacy, right? So we have I think for many kids, financial literacy primarily gets taught by the parents. Right. And parents have different levels of financial literacy themselves.
Right.
And I think that's one impediment. And then the second one is that, and if parents, if we're going to have that unequitable experience for kids, I think that makes a good argument for why you might want to have financial literacy built into the school system, because it is an essential skill, and it can be woven into other things you are doing, right? Like it links to numeracy, it links to math. You can put financial literacy examples into your primary and secondary education system, so that kids graduate with, are properly armed for those conversations when they get to university or college, and there's the line of business banks offering credit cards, that they actually understand, what they're signing up for.
I think one of the the times that I was very excited, it was when the Ontario government announced that children were going to be taught financial literacy in school. But Kaylie, I saw you nodding.
Oh, I'm just thinking about the inequity of access to financial literacy. So if you're lucky enough to have someone in your life who is comfortable, like we talked about in the first episode, who's even comfortable to talk about money in the first place, walk you through your choices, be okay if you don't follow their advice, and do something different than they would do, and know that you can still go back to them for more advice in the future, then how do you navigate the financialization of our lives? I think that's a great phrase to say things that way, whether it's buying a house versus renting, or going back to school, or even just, every day if you buy something online, being offered the chance to pay for it over 4 payments instead of 1 payment, and what that decision means. If you make it multiple times, what does that decision mean 4 months from now when you're making those payments?
And I don't know if you've noticed, every time you sign up now, give us your email, we'll give you 10% off, and then you feel like you have to buy it. Yeah, it's 10% off, but it's not a good idea. But anyway, thank you so much for helping us understand these terms. I feel more empowered than I did at the beginning of the conversation. Thank you so much. Tomorrow, we're going to be diving into debt. What is debt and what is credit? Thanks so much again. Our guests all this week are
Shay Myers, licensed financial advisor and educator of Finance for the Culture. Craig Alexander, president of Alexander Economic Views. Brett House, professor of economics at Columbia Business School and fellow at the Public Policy Forum. And Kaylie Tiessen, economist and policy analyst at Unifor, one of the unions that represents some employees here at TVO.
The agenda in the summer with Nam Kiwanuka is made possible through generous philanthropic contributions from viewers like you. Thank you for supporting TVO's journalism.